Hi students, this is Kumar. I have been teaching costing and financial management for past 15 years at IPCC and CA Inter, CMA Inter level, strategic financial management at CA and CMA final level. So I don't want to reveal what I'm going to discuss because the agenda of the meeting has been shown in this video presentation. So I spoke several discounted cash flow techniques in the previous video presentation. So like NPV, IRR, profitability index and discounted payback period. So NPV has been discussed in the previous video presentation. Now I want to discuss about IRR. So IRR is also known as YTM, yield to maturity. Of course, these both terms are used interchangeably, but the essence of competition is the same. So what is IRR? Why it is called as IRR? Any logic behind assigning the name of IRR to this concept? Next point, how the computation is done. Next, how it is important from CFO point of view. And next point, does it help to maximize the one of the core objective of financial management, that is wealth maximization. And finally, is there is any interlink between NPV and IRR. So all these points will be discussed with few examples so that you can understand this concept clearly. So let us start our discussion. So look at this. I have taken 4 examples to highlight this concept. First of all, you should have the basic understanding of what is present value and what is future value. Suppose I have 100 rupees in hand. I want to deposit this 100 in State Bank of India savings account where the interest rate of the deposit is say 4%. I want to keep this money for a period of 1 year. Then what happens? After 1 year, I will receive 100 rupees of my investment plus 4% return there, right? 4% on 100 means 4 rupees. 100 plus 4, 104 rupees will be taken after 1 year. Now tell me, in this case, we have two values, 100 today, 104. 100 is the current value that we call it as present value. 104 is the money which is received after 1 year. That is we call it as future value. Can I say future value is equal to current value plus return thereon? Current value is 100. What is the interest or return thereon? 4 rupees. 100 plus 4 is equal to what? 104. Therefore, future value is equal to present value plus return or interest. In general terms, for your understanding, I don't want to use return concept. In general language, we call it as interest. So 100 plus 4, 104. See, in future value, you can understand there are two components, principal and interest. So the interest which is included in the future value, that is technically known as IRR, internal rate of return. So let us see few concepts. 1, 2, 3, 4 examples are there. 100 plus 4 is equal to 104. Am I right? What I am trying to do, I am adding interest to current value to get the future value. This is called compounding. Compounding is a process of knowing the future value of your investment. Suppose I want to invest 10 lakhs in a land. So I want to know what is the value of land after 5 years. That means you are finding the future value of land. You want to purchase a business with an investment of say 1 crore and you want to know the worth of the business after 5 years. So this is called ascertaining the maturity or future value of your business after 5 years. So future value is equal to present value plus interest. The process of adding interest to the present value is called as compounding. There is another way. Say, I want to receive 110 rupees, 110 rupees after 1 year for an investment of 100 as on today. Then my question is, here what do you know? You know the amount of money you want to receive after 1 year. You know the amount of money you want to invest today. You know the period of holding 1 year. What is missing here? Rate of interest. So how to find this? Simple. Get the 110, you know, principal plus interest is equal to future value. If you deduct interest from the future value, what do you get? Present value, right? So first you have to discount. Discount means deducting the interest from future value, we call it as discounting. 110 minus x, that must give you how much? 100. So 110 minus 10, that will give you 100 rupees today. Means this in this 110, if you are deducting your principal, what is left there? Interest. So this interest, if you are expressing as a percentage, that we call it as an IRR. Means 10 on 100 is equal to what? 10%. Can I say principal plus IRR is equal to what? Future value. Future value minus IRR is equal to what? Present value. So that the process of deducting the interest from the future cash flow, that we refer as IRR. So that is why there is a definition for IRR. IRR means it is the discounting rate. It is the discounting rate. It is the discounting rate at which the present value of future cash flow is equal to investment. So IRR is nothing but a discounting rate. In our example, 10% is a discounting rate. If you are deducting, if you are discounting 110 with 10%, you are getting what? 100. Means IRR is the discounting rate at which the present value of future cash flow are equal to investment. So 100 is here, 110 is here. So what is the interlink between these two? IRR. So 110 minus IRR is equal to 100. So this process we call it as discounting. So let us understand. Now you understand the basic meaning of IRR. IRR is nothing but a discounting rate. So why you are using this discounting rate? To know the rate of return which was included in the investment. You can see, first example, we are investing 100 today to get 120 after 1 year. Now you want to know the rate of return on this investment. Then what you are finding? You are finding IRR. So how much it is? 20%. So that 120 future value contains your investment of 100 plus 20% return. So 120 minus 20%, what do you get? 100. That is why IRR is the discounting rate at which the present value of future cash flow, which is equal to what? Your investment. This is about first example. Second example. So what you are doing? You are investing 100 today to get 157.35 after how many years? 3 years. Now you can understand this 157.35 contains two components. Your investment of 100 plus some rate of return. I don't know how much return is included in the 157.35. So now I want to know how much return I am getting from this investment. So today I am investing 100, receiving 157.35 after 3 years. What is IRR here? 16%. 16%. So you want to check this whether the 16% is correct or not. Of course, we are rounding this value. The exact IRR is quite different. Look at this. What is the rate here? 16.31. It is not 60, 16.31. Take 100 rupees your investment. First year, you are getting a rate of how much? 16%, 1.1631. Second year, you are again getting a rate of 16.31. Third year, again, you are getting a rate of 16.31. So that you are getting a value of how much? 157.35 after 3 years. So, if you deduct 16.31% return every year for 3 years, you will get this 100 rupees investment. That means this 157.35 is having an investment of 100 plus a return of 57.35. If you translate this return in annual basis, that would be the IRR of the investment. So this is about example number 2, where you can see you are investing 100 today to get some return in the future. In the third example, you are investing 100 where you will receive 60 rupees in the first year as a reward, 60 rupees of return as a reward in second year, 60 rupees of return as a reward in the third year. In other words, you are investing 100 to get 60 rupees every year for a period of how many years? 3 years. 60 plus 60 plus 60, without considering the time value of money, you are getting an amount of what? 180. Out of this, your investment is 100. Means you are getting an absolute return of what? 80 rupees for a period of how many years? 2 years. Or a period of 3 years. Now I want to know the annual rate of return. The annual rate of return on this investment. How much it is? 36%. So 36% is the annualized rate of return on this investment of rupees 100. Then, what is IRR? IRR is the discounting rate at which the present value of future cash flows are equal to what? 100. Then, point number 2, why it is called as IRR? See, 60, 60, 60, put together how much? 180. First, you have to recover your investment of how much? 100. Means how much return you are getting extra? 80, right? So this 80 rupees over a period of how many years? 3 years. If you are dividing this return in 3 years span by considering the time value of money, that rate we call it as time adjusted rate or IRR. See, this 60 contains 2 components. This 100, some part of your investment of 100 will be recovered from the first year cash flow, second year cash flow, third year cash flow. As you know, future value contains 2 elements: principal plus interest, principal plus interest, principal plus interest. But we don't know the amount of principal we are getting from the each year cash flow. We don't know the amount of return which is included in these cash flows. So why it is called IRR? Because the rate of return is included in the cash flow. So we don't know the amount of return included in the cash flow. We can find the rate of return by discounting the future cash flows using X-ray. Suppose you tried with 20%, 60 its present value, 60 of second year its present value, 60 of third year with its present value. Suppose at 20%, the present value of all these cash flows are equal to 100. Then we can say every year cash flow, there is a 20% return included. First year cash flow, you are getting your principal plus 20% return. From second year cash flow, you are getting a principal of 100 plus 20% return. From third year cash flow, you are getting your principal plus 20% return. It is hidden in the cash flow. That is why it is called as internal rate of return. Unless the rate of return is known to you, it is practically impossible to get IRR of the project. So, third point, the computation is simple. For finding IRR, we should know the approximate rate. I know the IRR of the project, exact IRR of the project is say 36%. But I don't know, IRR of the project is 36%, but unless the rate of return was expressed or given, you are unable to calculate the IRR. Then what we have to do? Take 1%, discount all the cash flows and get the present value. At 1%, the present value of cash flows equal to 100, it is IRR. But it is not equal to 100. 2%, 3%, 4%, 5%, 10%. Like this, we have to do several tries. At 36% approx, the present value of cash flows are equal to what? 100 rupees. This is called IRR. Finding IRR is a difficult task. So that is why to find IRR, we should know the approximate range of the IRR. In the examination, they will be given two discounting rates. They call it as guess rates. Say 35%, 37%. Discount the cash flows by using 35%. You will get more than 100 in this case. Discount the cash flows with 37%. You will be getting a value which is less than 100. That means the IRR of the investment lies between what? These two. 35% and 36%. If you interpolate these two values, you will get the IRR of what? Approximate 36%. Third example is over. Fourth one, now you are investing 100, will receive 40 by the end of first year, 60 by the end of third year, 80 by the end of third year. Now you want to know the IRR of the type IRR. That's all. 32%. 32% is the annual rate of return. So first year cash flow is having some part of your recovery principal. You have to recover your 100 rupees principal from the 3 years cash flow. Some part of the principal will be recovered from first year cash flow. Means it contains some principal plus 20% return. Second year, some principal plus 20% return. Third year, principal plus 20% return. So because you are discounting at 20%, what happened? P plus I, you know, future value is equal to P plus I. So what is the I here? 20%. You are discounting at 20%. Then what happened? The interest in the future cash flow has been cancelled out. Then what do you get? Your principal. That is the reason why at IRR the present value of cash flows are equal to what? Investment. Are you getting what I am saying? So this is how the IRR is calculated. Next. So what is the importance of computing the IRR? See, take this example. You are investing 100 today to get return for a period of how many years? 3 years. How much return you are getting now? 32%. Suppose if you are a CFO of the company, before investing 100, you must ensure that how much return you are going to get from the investment. See, your company is getting funds from the several sources. The cost of borrowing of this, say 100 rupees is 20%. Means you are borrowing money at 20%. You are investing this in a project. It may be a plant and machinery, it may be a furniture, it may be a machinery, it may be a land and building, etc. Any asset, any long-term asset. But you must ensure whether this investment should give a minimum return of 20% or not. Because if you fail to get 20%, you are unable to justify the expectations of the investors. So if you compare this, we are borrowing the money at 20%, but we are investing at what rate? 32%, which is more than what is expected by the providers of finance. So if the project IRR or if the IRR of investment is more than the cost of borrowing, you will be in a profit zone. 30 to 20 extra 12%. If the project is able to provide anything in excess of what is expected by the providers of finance, those projects are profitable. Those projects helps to maximize the wealth of the shareholders. So wealth maximization is tie up with the IRR. So that is the reason why most of the CFOs are trying to get a return which is in excess of what the minimum rate of return expected by providers of finance. Hence, for maximizing the wealth of the shareholders, we should look at the projects where IRR is greater than cost of borrowing. Next, last point, what is the interlink between IRR and NPV? This logic is simple. So what is 20%? It is my minimum rate of return. Suppose if this 100, if it is not invested here, I am failed to provide the minimum rate of return expected by the providers of finance. So shareholders, lenders, you are getting money from the shareholders, you are getting money from the lenders. So it's shown in the liability side of the balance sheet. At what cost you are borrowing? 20% you are borrowing. So then this will be invested. Then after investment, this will be shown in the asset side of the balance sheet. So this asset where you are investing money, that should give a minimum rate of what? 20%. So that is why I am discounting this 40 with 20%. I am discounting with 60 with 20%. I am discounting with 80 with 20%. So what is 20% minimum rate of return? So 40, this includes P plus 32, where you are discounting at 20%. Means after discounting, you left with P plus 12%. Second year, P plus 32, you are discounting at 20%. After discounting, you left with P plus 12%. Like this, while computing the NPV, what we are doing? Present value of cash inflows minus investment. If you take, what is the present value of cash inflows in this case? After discounting, how much return is left? P plus 12%. Sum of present value of cash inflows minus what? Your investment P. P cancel out. How much return is left? 12%. So this 12% is technically called as NPV of the project. So you are getting NPV, you are getting positive NPV only when the IRR of the project is what? Is greater than cost of capital. You are getting negative NPV when the IRR of the project is less than cost of capital. Let us assume 32% return is included in the cash flows, but you are borrowing money at 40%. Then what happened? 32, you are discounting at 40, minus 8% is there. Means you are losing 8% return by accepting this project. So that is the interlink between NPV and IRR. So when IRR is greater than cost of capital, NPV is positive. And when IRR is equal to cost of capital, NPV becomes 0. When IRR is less than cost of capital, the project NPV becomes negative. So I hope you understand all the points which are mentioned at the presentation. What is IRR? Why it is called as IRR? How it is computed? And why it is important from the CFO point of view? And last one, the interlink between NPV and IRR. Whether the IRR is enable the company, enable the CFO to maximize the wealth of the shareholders. So all the points have been discussed. So thank you. Bye.